characteristics and trends. Management and promoter strength is also a very important aspect. The professional experience of a valuer has a significant role in choosing and applying different methodology and concluding value. So you cannot say that one formula is fit in for all types of valuation. Is totally different. And the business valuation is critical for transaction, including fundraising, M&A, sale of business, strategic business decision, like family or shareholder dispute, valuation for voluntary value assessment, and also for regulatory and financial reporting in accordance with the applicable law. So you require different valuation in different situations. Valuation is therefore more than just a financial metrics that you are just calculating numbers. It is a strategic tool that shapes business decision, influences regulatory compliances, and drives financial reporting accuracy. In an ever-evolving business landscape, understanding the nuances of valuation is crucial for professional and organization alike. Today, when we say purpose of valuation, stage of valuation, these are the two important things. In this time horizon, short and long term, that is also important. Type of shareholders, minority shareholder, controlling shareholder, strategic investor, M&A type transaction, all these requires different types of valuation. Today, the purpose of this webinar is to provide valuable insight and practical knowledge on the critical subject. We want to discuss the various concepts, the valuation overview, that how valuation is not just a number, it's a strategic tool that guide business decision, ensure regulatory and compliances, and maintain financial accuracy. Second point we want to discuss today, fundamentals of valuation concept. To understand valuation, you must understand and grasp the concept and fundamental point of view. So we will discuss concepts like time value of money, risks assessment, market dynamics, also from the bedrock of accurate valuation. So this is part of fundamentals of valuation concept. Third topic we want to discuss today, dispels myths. Now, there are so many myths and conceptions surrounding valuation. We will debunk some of these myths and show you how they can lead to costly mistakes. Clarity in valuation is paramount, and the valuation concept is very clearly we want to discuss. Somebody say valuation is an art, somebody say valuation is science. So all these things we want to discuss. Then requirement of valuation requirement. So valuation requirement is not fixed. It can be for anything. It can be for valuation relating to family settlement, M&A, regulatory, and various other things are there. Then come to approach and methodology. When valuation is finalized, so the concept is very clear. Valuation is not one size fit to all things. We have to explore various approach, methodology, including income approach, market approach, asset-based approach. You will gain insight into when use each methods and their strength and weaknesses. Then the last point we want to discuss, future of valuation industry. Now, valuation was a part of one curriculum of the chartered accountant and one curriculum of professional of company secretary and other people. But the way valuation industry is changing shape, valuation requirement is changing, regulatory aspect is changing. We want to go ahead and discuss the future of valuation industry, emerging trends in technology, such as artificial intelligence, blockchain, and are post-revolutionizing valuation practice. And we'll discuss how the innovation can enhance accuracy and efficiency. Friends, as you are aware that concept of valuation was confined to CA earlier. Then merchant banker came, then came to the registered valuer, and then came to IBBI, and the registered valuer institution concept has come. Now, today what is happening? Slowly, all these places where the chartered accountant and the merchant bankers are there, it will replace with the registered valuer. And the IBBI is also an institution who is looking after. And shortly, there is a possibility that separate valuation institution will be there, and they will manage all the professional, all the exams, all their capacity building and the future and the standard on valuation. Today, what is happening? Valuation, when you are doing on the basis of your perception on various aspects, then there's a need of standardization also. International Valuation Standard Council is there. They have their own valuation, but in India, it required the existence of this. Chartered accountant had made, but IBBI has not finalized, and they are working on this. So we can understand that these are things we will discuss today. Friends, when we are discussing, then question is that how many types of valuation are there? Market valuation, comparable company analysis, comparable transaction analysis. Then we have income valuation, discounted cash flow, capitalization of earning. Then we have asset-based valuation, asset approach, liquidation approach. We have a cost-based valuation, replacement cost, historical cost. We have an option pricing valuation method, Black-Scholes method, real option analysis. Then we have an intangible asset valuation, because brand valuation is also now very popular nowadays. IP, intellectual property valuation is there. Then startup valuation is there, where the venture capital method system is there, risk adjusted system is there, real estate valuation is there. Then come to the natural resources, when you are taking out the mines and other thing, where reserve-based valuation and the royalty and income-based system valuation. Now, these are the things you can understand, that these all things are so specialized, so complicated, that everything has to take a shape. Now, this is not only the valuation concept and the future. The future depends upon one very important aspect, that what are the development will take place in future. And one aspect is there, that is technology. So advanced technology integration will take place, and this artificial intelligence, machine learning algorithms will play a very significant role to analysis of this data, because valuation is not confined to the one country, it is the entire world. And today, when the globalization is taking place, so anybody can buy any asset from this part to other part, and they can simulate, analyze that what is the cost in India, what is the cost of other part. Indian businessman is going out, they also analyze. So advanced technological integration is very, very important. Blockchain for asset verification is also a concept which will come, which is a transparent and tamper-proof. Then data analysis and big data. Now you can understand the valuation is not a only science, it's a science or art, it's a combination of both, or it's a perception, or it's a valuer, what he is thinking. But ultimately, behind everything, you require some knowledge and some data analysis. So you have to see deeper, you have to go into market trends, risk assessment, and asset performance. All these things you have to do. Then come to ESG. ESG factor is also becoming very, very important in future. And every valuation will need to incorporate ESG metrics to assess the sustainability and long-term value of the asset affecting investment decision. Today, what you are buying is not important. Whether it's sustainable or not, that is most important. Today, you are buying something which is on the diesel, and you are aware that diesel is creating more pollution, and the government and regulatory body is working out to remove this. So if you value today, you have to see this concept also. Regulatory changes, there are so many changes, stringent requirement is coming, standards are coming. This is also very important aspects, that how you plan for this. Then globalization of cross-border valuation is also taking shape, because globalization, which I just told you, in the cross-border valuation, because you are buying asset of other countries buying here. So you have to have this, and that require an international accounting standard. First, you have to make Indian accounting standard. and then you have to go for international accounting standard, and relating to this, you have to make the valuation standard, because tax, cultural nuance, there are so many things which you have to take care. Alternative asset valuation. Now the valuation like cryptocurrency is there, the non-fungible tokens are there, digital assets are coming. All these things require, and this is more, it is not a common. So these are the unique asset which has to take place and you have to do. Like ESG, I told you, same thing, sustainability and impact investing is also the part of the valuation, that how you are investing, it will impact. Then interdisciplinary collaboration is also will take place, where valuation professional will collaborate with more closely with the expert of that field. Suppose you have to do valuation of mines, then you have no expertise, you are a financial guy, but you require somebody who is a expert in mines and can see this. Today we are seeing the government and Reliance is fighting because of the oil extraction process. They are saying you have to take out this much, and they are saying we are doing. So this is the dispute, and this dispute can be solved with the help of the expert. So in your valuation also you require ethical and bias consideration should not be there. And so ethics will take a more important aspects. And then to do all these things, capacity building is most important. And for that, you have to have a continuous professional development. So the institution of valuation, which is in the process, IBVI is managing, but in future, separate institution will be there, and they will run the entire show of valuation. And the valuation institution, I'm seeing a huge development, a huge things which will take shape. And we can realize this, that valuation aspect will see a new changes, and the new parameter, new area of emergence is taking place. With these things, we will discuss this issue today, and for that we have our experts for today's program. We have Mr. Manoj Kumar, Partner Head, M&A and Transaction Corporate Professional. I welcome Manoj. Then we have Sanchit Vijay, Partner Head and Deals and Valuation Corporate Professional. Then we have Mr. Devashish Das, Director Corporate Professional, Valuation Services Private Limited. And all three people, they have their expertise. They have done valuation more than 1,000 companies in different industry. So they will tell us about these topics and issues. The program structure will be like this. First, Sanchit Vijay will speak and tell us about the various aspects of valuation. And then Manoj will discuss, and then Devashish Das will discuss. All these three people will discuss. Then we have some questions, and you have any question, you can raise these questions, we'll to answer. So over to you, Sanchit. With this, you can start your presentation.
Thank you so much, Pawan sir, for such a great introduction on the valuation and its framework and the context that we would be talking about the transactional, regulatory, and financial reporting. So with that note, we start with the presentation. What all things that we would be covering in the presentations are: number one is the valuation overview. The second is the valuation process. Third, the framework of the valuation. Fourth, the regulatory provisions. And then the fifth, the future of the valuations in the Indian regulatory context. So starting with the valuation overview, let me first define what exactly valuation is. So valuation or business valuation, also known as company valuation, is the process of determining the economic value of business. During the valuation process, all the areas of a business are analyzed to determine its worth and the worth of its separate components. So when I say economic value, we take into consideration the business, the company, and the assets. Now, what valuation actually represents? So it represents both the future expectations from that business and both the past performances. So we will consider the future expectation and past performance whenever we are valuing a company. Now, what it would represent is taking into consideration both the qualitative and quantitative aspects. So now while quantitative in nature, being evaluation, it always involves some or the other degree of the qualitative aspects. The quantitative valuations or quantitative aspects are based on mathematical models or equation that attempt to predict the future cash flows or related numbers with the company. The qualitative are based on observations and evaluation of companies' assets. So let's look into what certain aspects of qualitative areas that we would be talking about is. Number one, we'll start with the regulatory environment. So this refers to the laws, regulation, or government policies that affects that respective industry and the business that we are valuing. Changes in all of these can impact the operation, the compliant cost, and market access, all of that which can influence the value of an asset or a business. The second is the consumer behavior. Understanding the consumer behavior is very crucial for valuations, actually. It involves analyzing how consumer make purchasing decisions, their preferences, buying trends, and the factors that influence their choices. Changes in the consumer behavior affects the demand and in turn affects the direct revenue of a company, and which affects the valuation. Third, the qualitative aspect would be the technology trends, so technology trends encompass all the advancements or innovation within that industry, and it is very essential that we keep up with all these technological development, as they can lead to improved efficiency, probably new product offerings, increased competitiveness, and which all of these factors can impact the valuation on a very massive level. The fourth would be industry growth and type. So the type of industry in which a business operates and its growth prospects are very important qualitative factors. Different industries have different risk profile, growth potential, which can affect the valuation approach and also the expected return in future. Fifth would be the geopolitical factors. This includes global events, political stability, trade agreements, conflicts that can have substantial impact on a business operating internationally or even in the industry, which can affect valuation. Sixth would be strategic alliances. Strategic alliances and partnership with other business can definitely add value, which in turn affects the valuation. And last, in the qualitative aspect would be the market share. So when I talk about market share, it indicates the portion of market that is controlled by that respective business or company that is being valued. A larger market share often implicates a stronger competitive position and can positively influence valuation. However, it is essential to consider the sustainability of market share over time. The quantitative aspects are the numbers that are contributing to the financial statements. Some of the quantitative aspect that we take into consideration while valuing is the earning multiple, the debt and equity structure that the company has, the revenue and the growth of the revenue, expenses along with the projected expenses, the cash flow that the company is earning, any profitability metric, or the assets and liabilities of that respective company. So whenever we do a valuation, we have to take into consideration both these qualitative and quantitative aspects. Now, let's talk about certain misconceptions that are being going on around valuation. We'll talk about what the myth is and what exactly is the reality around it. So number one myth is that valuation is objective. However, that is not the case. Valuation is inherently subjective and not objective because it relies on combinations of the qualitative and quantitative assessments that we just spoke about. While financial metrics provide a foundation, factors like market perception, management quality, and industry context introduce the subjectivity into the valuation process. And different valuers may arrive at varying valuations based on their judgment and assumption and giving different values. The second myth is that valuation gives a precise number. However, that is not the case. Valuation is basically an estimation and it's not a precise value. Since there's a lot of assumptions and various methods that are being used by valuers for valuing a company or business, and due to the complexity of the factors involved and inherent uncertainty in the future, valuation can vary and best understood as an educated estimate rather than exact figure. The third myth is that a single valuation serves more than one purpose. However, that is not the case. Valuation will change if the purpose changes. So, if I may say that valuation is very purpose driven and a single valuation does not fit all needs. The value of a business or asset can vary significantly depending on whether it's for sale, financing, tax purposes, or any other use. The intended use or intended purpose of the valuation guides the methodology and the factors considered, highlighting the importance of aligning the valuation with specific objectives. Um, the fourth myth is that valuation is a science. However, I would say that valuation is a very dynamic process that considers past, present, and future. It takes historical financial data, current market conditions, and forecast to determine the value of an asset or business. The comprehensive view recognizes that value is influenced by continuum of not just of time and not just a single moment. And all of this makes it not just science, but as well as an art. Um, Again, as I spoke about, let's talk about what are the fundamentals of the valuations that we have to take into consideration before any company is valued. There are precisely four fundamentals that we need to take into consideration. The first is base of value, premise of value, factors of value, and then what is actually the difference between value and price. Let's talk about first the base of value. Base of value, or also known as the standard of value, is described as the fundamental measurement assumption on which our valuation would be based upon. There are precisely three bases that we take into consideration whenever we follow a valuation methodology. First is the base of fair value. Now, the base of fair value is the price that would be agreed between a willing buyer and a willing seller in a business, and there is no pressure on either of the party to buy or sell. So the determination of fair market value involves thorough analysis of both qualitative and quantitative factors. It's basically an arm's length price at which the asset would be exchanged. The second is the base of value of investment, where the base, that is the investment value, is the value of business to a particular buyer based on the buyer's unique investment criteria. It is assumed in this case that the buyer has specific synergies with that respective business, and such an access to proprietary technology or the distribution or any strategic advantage that it may have would affect the valuation. So that means that the value of future benefits of the ownership of an asset is to a particular buyer and not to general public at all. And the third is called as the intrinsic value. So the base of intrinsic value is the true underlying value of a business based on its financial and operational performance. It's the quantitative figure that assumes that the business is being valued on its own merit rather than any part of a transaction. So there are different premises of valuation. Few of the premises we have mentioned. So premise of value refers to the underlying assumption and conditions under which the valuation is performed. So it is of very utmost importance while undertaking any valuation or assignment, because there is a significant change in value if it is valued probably as a going concern or a liquidation. So now let's talk about a few of them. So going concern premise is basically that the business will continue to operate as a viable entity for foreseeable future. And the going concern premise will assume that the business would be operating indefinitely without the need for liquidation or significant changes. The premise is very crucial for valuing established and ongoing business as it reflects the ability to generate the future cash flow. The liquidation premise is assuming that the business will be sold in orderly liquidation, where assets are sold off and liabilities are paid. It assumes that the business will not continue to operate as a going concern. So the approach focuses on the estimated value of the company's net asset as if it were to cease operation and sell off its asset. The value in use assumes that the business will continue to operate, but that it will be used for a specific purpose or by a specific buyer. It assumed that the business will generate cash flow that are specific to intended use or user. The highest and best use is generally used for non-financial asset. As per the premise, the value of an asset is the value when used by a market participant who puts the asset to its maximum use. Post transaction, as it is very clear from the word itself, is that sometimes an owner or a company or an asset may be under a compulsion to sell or transact within a limited period of time, as a result of which he or the company may not fetch its true value. So the premises actually affects what the value is going to be like. Now let's talk about what the factors of the value are. When I say factors of value, there are two things that any valuer has to take into consideration. First is the methodology. We would be talking a lot in detail about what are the methodologies, but a methodology has to be chosen while doing the valuation. And the second is called the perspective. When I say perspective, it could be enterprise value or equity value. To give you a little information on enterprise value, the enterprise value is the total value of asset or the business without including the cash. So it is basically the market share, market capitalization, plus the debt the company has, and net of cash. That is what the enterprise value. Whereas the equity value is the value that remains for the shareholders after any debts that have been paid off. So that is the brief distinguishment between enterprise and equity value. Now, the difference between what value is and what a price is. As I said, value is a subjective term, as what is the value to one person may be inconsequential to another. Whereas price may be understood as the amount of money or the other consideration asked for or given in exchange for something else. Value may not necessarily require the arrival of transaction, but price is the outcome of transaction. Value depends upon a lot of factors of qualitative and quantitative, whereas price is basically the ultimately selling price, which may be greater or lesser than the value. There are different purposes that we need to do valuations for. Probably understanding the internal decision making, for any buy or sell agreement, any exit strategy planning, estate planning, fundraising, ESOPs, regulatory reason, developing a succession plan, any shareholder or partnership disputes. So there are a variety of reasons on why any person would require valuation. And that is what we are trying to capture here, that the valuation purposes are predominantly into three categories: transactional, regulatory, and financial reporting, where transactional valuations are on the basis of any event or any transaction that may occur for which we require valuation. Regulatory is for any requirement by any regulatory authority that we require valuation for. And financial reporting would be for the creation of financial statement that we require valuation. Let's talk about the valuation process. So valuation process is a 5-step methodology process where first we talk about identifying the purpose. When I say identify the purpose, it is clearly establishing the purpose of the valuation. That is, what is the base of value, what is the premise, and all of these drives the choice of valuation methodology and an assumption. It is very essential because the complete process would be dependent on this. And that is why we need to identify the purpose. The second is gathering the relevant information for the purpose that we have identified. That means collecting the financial data, collecting all the income statements, balance sheet, cash flow statements, auditor reports, all of that. The third step would be after the relevant information has been gathered, selection of the appropriate valuation methodology and approach. whether income approach would be applied, market approach would be applied, or cost approach would be applied. We will talk a lot in detail about what income approach, market approach, and cost approach are in the follow-on slides. The fourth factor is evaluating the qualitative factors like the industry trends, market conditions, competitive analysis, and all of that. And the fifth aspect would be calculating the value and preparing the report, which is the culmination of the valuation process. This final value is a key reference point for the decision makers, whether they are investors, buyers, sellers, or regulators, as it may be. Now, who can do actually valuations? Predominantly in the Indian context, a registered valuer, a merchant banker, and a chartered accountant can do valuations in the securities and financial asset class. From the very beginning, earlier, chartered accountants used to do valuation. But as we are progressing, it started off with merchant bankers and now registered valuers. Registered valuers are given the authority to do valuations under Companies Act. Merchant bankers have authority to do valuations under the Income Tax and FEMA Act. Slowly and steadily, a lot more reliance is being given to registered valuer, and in the coming future, a lot of more valuations would be done by registered valuer in place of chartered accountants and merchant bankers. Now, let's talk about certain factors that affect valuations. We will talk about factors starting from financial performance. So when I say the historical and the projected financial performance of the business is a central factors that really affects valuation. Revenue growth, profitability, cash flows, earning history, industry stability and trends are a lot of things that affect the valuation when it comes from the financial standpoint. When I talk about the industry and market trends, in the industry trends, the growth rate that the industry in which the business operates is a critical factor. The overall size of the market that industry addresses is a critical factor, because a larger market size may imply greater revenue potential, attracting higher valuation. Emerging markets, there are certain times when business operates in emerging markets or industry which may be valued more optimistically, keeping in mind the future cash flow due to untapped opportunities for growth and expansion and having higher valuation. The fourth factor would be the cyclical or non-cyclical manner in which the industry operates, which may affect the valuations and its volatility. The marketing trends would be the consumer preferences, the market share, and the competitive dynamics that the company or the industry that operates in that affects valuations. When I talk about the economic factors, broader economic condition, including interest rate, inflation, or overall economic health, all play a vital role in influencing a company's valuation. Investors closely monitor these economic factors to assess the potential risk and opportunity associated with their investments in specific companies and industry. Probably, I would say a strong and stable economy generally supports higher valuation, while economy challenges and instability can lead to a lower valuation. When I talk about size and scale, the size of the business or assets can affect valuation. Larger businesses may have economies of scale and access to a broader market, potentially leading to a higher valuation. It is very important to note that while size and scale can be advantageous, they don't really guarantee a higher valuation. Economies of scale, market dominance, access to capital, diversification in the business, and risk mitigations are some factors that really affects our valuation on both plus as well as minus side. The customer base, diversity, loyalty, and stability of the customer base also is one of the major factors that affect valuation. Long-term customer relationship and recurring revenue streams may enhance value and leading to a higher valuations. So recurring revenue streams, long-term customer relationship, customer acquisition cost are certain things that affect valuations. Regulatory environment, a very important factor where changes in the regulatory environment, compliance cost, or legal risk can impact valuation on a very higher level. Regulatory uncertainties may reduce a company's value. The technological advancement. So as we talked about, the technological advancement, it plays a pivotal role in shaping the value of a company and industries. Rapid technological changes can disrupt industries and impact the value of companies. So probably disruption, innovation, competitive advantage, innovation and intellectual property, or even the risk of obsolescence can be a reason of factors that are affecting valuations of a company, which may attract a higher or a lower valuation, as the case may be. Geopolitical factors. So when I talk about geopolitical factors or events, trade policies, international relations, war, can introduce uncertainties that affect the valuation of business with global exposure. As we are moving towards globalization, a lot of countries are interdependent on each other, and which affects and brings exposure to geopolitical risks that must be carefully managed to maintain and enhance a company's valuation. So that is all from my end. Now, Mr. Manoj will take into consideration the valuation framework and the regulatory requirements of valuation going forward.
Thank you, Sanchit. Thank you very much. Giving a very nice presentation. As a registered valuer, you have done so many valuation. So when you have given the overview of the valuation, now the question is, what is the framework and approach you have to follow? Because situation is different. In different situation, you have to follow the different methodology. So Manoj, please explain what are the approach and framework you follow.
Yeah, thank you very much. Good evening, friends. So whenever we talk about the valuation, we have to understand through what approach a valuer will derive the valuation for a specific purpose. So there are various approaches. Three of them are very important. So just let me share my presentation. Yeah. So if we talk about the framework under which valuations are done, so there are three major approaches under which all kind of valuation is done. If we are talking about the asset class, which is security and financial assets. So first one is the cost approach, second one is the income approach, and third one is the market approach. So if we talk about the cost approach is basically, it is derived from the assets of the company. So whatever the assets are employed in the company will be valued. This kind of valuation is very basic valuation, which is done for many kind of specialized kind of thing. Like if the assets is specialized assets and unique assets, which can have very good valuation, but whatever cost has already been incurred by the company, that need to be valued. So in such kind of assets, cost approach is the best approach to apply. Then if we are talking about a newly constructed or under construction projects, in such cases, valuation has to be, because there is no earning and it is real estate based or tangible asset based entity. So it need to be valued through cost approach only. Then comes damaged or partially destroyed asset. If you are the company is not earning or asset is not earning and it needs certain investment, then only it will become profitable or cash earning generating income generating entity. Then in such cases, cost approach is one of the most common approach which is used. Then comes to non-performing or non-going concern companies or businesses, like under liquidation scenario. In such cases, there is no cash flow, no visibility of cash flow, and hence valuers generally apply the cost approach. The pros and cons of cost approaches are basically, if we are talking about the cost, we can clearly visualize it through the balance sheets of the company. So it is objective and tangible. It can be it can be verified easily. It is very much useful for unique kind of assets, like I have already told. Then there is a transparency because it is available. The assets are available on ground. It can be easily verified, and hence the transparency is there. There is no question of any presumption objects or of the valuer. it also gives a very conservative estimate of the value of the business or the assets we are talking about. Then, but there are certain cons. It does not reflect the market reality, market dynamics of the business or the assets. It does not cater to the future earning capacity of the company or business. It simply says that whatever assets are there, what is the value of that asset. Then obviously, because it is not giving the future earning, and the purpose of business is to earn, it has very limited utilization, and generally it is not used for running business or going concern business. There are other challenges like determination of what should be the right depreciation, or when this asset need to be replaced. Those dynamics are not factored into while valuing under the cost approach. So these are the under these pros and cons. Very limited utilization of cost approach is there, but it is used sometimes. And there are two major methods under the cost approach. First one is replacement cost, and second one is the book value. So replacement cost is basically the estimation of rebuilding the same asset or recreating the same business. Whatever will be the cost, that will be the replacement cost of the business or the asset. And the other one is the book value. It is a historical value which is already built into the books of the company. So these are the two approaches under the two methods under the cost approach of valuation. We use the replacement cost method in case of we know we have to determine the cost of production, then current consideration, no consideration for market valuation. It will never use the market value of the market, what market will factor in if we go for selling the asset or the business. Those factors are not considered. But this, like insurance purposes, if we are talking about the insurance, then they generally consider what is the replacement value, and based on that they give the valuation for the assets which is getting insured. If we talk about the historical cost or book value cost method, it is pure historical. So there may be certain past where the asset has very good value, but because of the depreciation, because of wear and tear, the value had got changed. But that will not be taken care of. Only the depreciation which is already built in the books would be factored in. Then it is generally used for real estate kind of thing, or assets, tangible assets kind of thing. It focuses on the balance sheet of the company. It takes the estimation of the depreciation and amortization and the usefulness of the assets. It is used basically in the asset intensive industries or businesses. If we talk about the next approach, which is the income approach, it is most widely applied methods of valuation, and it basically helps in the investment decision making of the company. It is used for all such industries where a lot of long-term cash flow can be envisaged, like hospitality, like hotels. So whatever the earning can be, it will be for a very long time. Then if we are talking about the power plants or any other method, any other assets which can give earning for a longer period of time, income approach is the best suited method. So then if you are talking about the intellectual properties like patents, so patent has life of 15 years. So over a period of 15 years, it can keep earning the cash, and hence income approach is the best method to apply here. Whatever, if we are talking about the income approach, there are certain pros and cons of this method also. First pros is the forward-looking. It is forward-looking. It factors the possibility of cash earning over a period of time, and hence it is forward-looking. It is applicable to all income producing assets, maybe manufacturing business or real estate or hospitality, power generating assets. All those kind of assets can be, or businesses can be, valued through income approach. Then it reflects the economic reality, because we consider the risk factors, and based on that we give the discount to the future cash flows, and hence it is very good, useful asset for useful method to determine the real value which this company or this business can earn for investors. So investment decision makings become very much easier. The cons are basically it has a lot of subjectivity. We have to estimate the future cash flows. So estimation is always subjective, and hence there is a risk of wrongful estimation. Then there are complexities. There are various factors which can change. Dynamics of the environment can impact the valuation of the company. Obviously, as we have said, this method can have the limitation of subjectivity. Cash flow estimation may be difficult in some cases. So these are the inherent challenges of applying the income approach. How to do, if we talk about the income approach valuation, we determine the future cash flow. Then we determine what should be the discount rate to bring the cash flows to present value. Then based on the discount rate, we determine the present value. And then the most important aspect is the terminal value. So any projection of cash flow can be for a limited period, let's say 5 year or 7 year. But in some cases, it is very difficult to and the life of the business or life of the asset can be much higher than these 5 or 7 years. So after that period, it is assumed that the business or the company would get stabilized and there will be consistent cash flow over a period of time. So for this perpetual income or earning, a terminal value determined. Here again, there is always contention. Each valuer has different approach towards it. So sometimes perpetual valuation growth may be 5%, maybe 3%, but that is pure guesswork of the valuer or the management who is projecting the cash flow. So these are the basic challenges. Then comes the market approach. So market approach is basically comparing the assets of the company or the business with already listed entities or listed or transactions which are happening in the market. So market approach can be applied for publicly traded securities only, because it is then it has liquidity and it can be determined. Market approach, if we are talking about the transaction-based approach, we can also be applied for real estate. So real estates can be valued. One transaction is happening a nearby location at certain price. So nearby assets would also can fetch near to that same amount. So that market approach can be applied. Mergers and acquisition, startups and private equity investments, intellectual properties, and unique or antique things are generally valued through market approach. Main pros and cons of market approach are basically the determination of market data, how to find out the real and correct market data about the company, who should be considered to be the actual peer or actual comparable companies or comparable transaction. That becomes very challenging for the valuer. It has very wide applicability and generally it is used as a thumb rule valuation. So let's say we talk X company is trading as at 20 times of the price of the earning of the company. So similar companies can be valued in the same range, simply multiplying the profit after tax into to the 20 multiple, and that valuation can come. So it is a thumb rule valuation, and generally, so it is very generally applied. Then, but it factors the market sentiments, because each industry has various dynamics, various environmental aspects, and those are assumed to be factored in the market price of listed securities. It is generally used to benchmark the assets of the company or business of any business which is being valued. Then it has challenges or cons that the availability of the comparable data is very challenging. There are database companies which provide those data, but still the company's business and the business already listed may not be exactly comparable. So that is the biggest challenge, and we have to factor those aspects. Then it does not consider the future aspects. So if the company is presently having certain value, certain profitability, or certain sales, the future may not be the same. It may be sometimes 2 times, 3 times higher in next 2 years or 3 years, but the market would not factor those things. So those aspects are not known to the market, and hence may not be factored in by the market. Similarly, valuer is considering the historical data, or historical performance, so which may not be true for the future. Then there may be certain situation where the comparables are illiquid, so there can be distorted market price or market comparable multiples available. which will give wrong impression or wrong valuation to the company. Then there may be situations where the market is also distorted. So let's say due to certain external factors, market has given huge discount to certain industry, and we take that multiple and apply to our company, then it will be not a correct way of valuing the asset. It may not reflect the true potential of the business. Market approach, there, as I have discussed, there are two methods to determine market approach. One is the comparable company analysis, and another one is precedence of the comparable transactions. So comparable companies are those which are already listed and frequently traded on stock market, and their data can be extrapolated to the target company for which we are doing the valuation. Let's say we determine the price earning multiple of the industry, a certain industry. Let's say we talk about the power sector. So thermal power companies are getting X multiple, XP multiple. So similar multiple may be applied to the target company, and based on that, estimated value can be determined. Similarly, any other industry, we have to determine the real comparables of those entities, and based on that, the valuation can be determined. On another aspect, another way is to determine the precedents or the past transactions, or near by the past transactions, and that multiple or that same parameters may be applied to the target company, and based on that, transaction value can be determined. Let's say in certain locality, a property is being sold at, let's say, 50,000 rupees per square meter, and the target company has also the property nearby. So their valuation can be determined through this precedent transaction method. Similarly, if certain company is not listed, but there has been a transaction under which private equity or any third-party strategic buyer has bought the business at let's say 2 times of the sales of the company, and similar industry is being valued. So we can say that if the target company has X sales, the valuation should be 2X. So that can be transaction based method can be applied. While considering the comparable company analysis, we have to determine selection of the comparable companies very, very critical. If we are correctly choosing the comparable companies, then obviously valuation would be near to the fair valuation. Then valuation metrics would be created, and certain adjustments would be done. Which of the multiple should be applied, that is very important. Whether it should be price earning multiple, whether it should be EBITDA to EV multiple, EV means EBITDA to the enterprise value multiple should be applied, or certain multiples of the sales, or certain multiples of the book value. So these are the multiples which are available for the listed peers, and then there should be certain adjustment. Like if the size is bigger, then certain discount should be given for that. Size is smaller, then discount should be given for the size. Then if the companies for which we are doing the valuation is unlisted, whereas comparable has been taken are listed, so there should be some lack of marketability discount which will be applied. So then these kind of adjustments should be there. Then there may be certain situations where are unique situations, like generally manufacturing setups are done on the own property, whereas in this case properties are not there. Property is owned by some other company, and minor lease rental is paid because the property is owned by some promoter or promoter group company or near or some related party. In such cases, normalized profitability need to be recalculated. So such kind of adjustments are done, and then the multiples are applied to determine the fair valuation. Sometimes exact peers are not available, or sometimes company is doing more than one kind of falling under more than one kind of industries, and their multiples are different. Then there may be a requirement to split the business valuation into 2 or more parts, and sum of part valuation can be determined to find the fair valuation. If we are talking about the precedent transactions or comparable transaction analysis based valuation, then it is important to determine the comparable transaction, which is very much near to this. Time gap should not be very high, and those kind of transactions are data is gathered. their multiples are determined, and then there may be adjustment for normalize profitability or sales or whatever the applicable multiple we are applying, normalization or adjustments will be done, and based on that, multiples are applied to determine the valuation. There may be certain discounts or premium being given based on the factors which are better or worse than or less than the comparable transactions, and that would be the fair valuation estimate given by the valuer. Then we talk about certain unique kind of assets for which these approaches may not be fully suitable, like tangible assets. So one method, as we have discussed, tangible assets may be valued through income approach by determining the income over a period of time, and their income may be brought to the fair value, present value, to determine the fair value of that intangible asset. But there are maybe situations where the intangible asset is only one component of the entire business, and hence it is difficult to determine the cash flow of that particular intangible assets. So for that exceptional cases, we have to apply different methods. Similarly, if you're talking about the startups, there may be huge potential, but at present there may not be cash flow or may not be sufficient profitability. So comparable company or cash flow determination becomes very challenging. In such cases, it is difficult. Then there may be a situation where our companies are loss-making, not started earning, or maybe because of certain factors, it is not giving cash flow, positive cash flow. In such cases, neither the income approach would be a true method, nor the comparable transaction can be determined. In such cases, unique different methods are applied. So if we talk about the exceptional intangible asset valuation, it basically there is no tangible things to determine or touch or feel or valued by the experts. There will be a lot of subjectivity on the utilization of the intangible assets like goodwill or brand or the capacity to earn by the brand. Then there may not be comparable market transactions to compare it. There may be complexities like some patents are there. So its utilization or utility may not be easily determined by the valuer. The valuer may not be expert to that in the area. Then there may be regulatory or legal risk relating to those intangible assets, and there may not be historical data. So all those things would make that valuation very challenging for intangible assets. In such cases, there are certain methods which are already well established, like royalty relief method, where it is where the valuation is based on the estimation of the royalty which need to be paid if that particular know-how or patent is to be taken from someone else on royalty. So that royalty is not being paid because the company has or the business has already generated that intangible or acquired that intangible assets. So that discounting would be done. That cash flow will be consolidated after doing the fair discounting for the earning period, and that is called the relief from royalty method. Another method is with or without method. So here the valuation is done in two parts. One with that particular intangible assets, and based on that the cash flow is projected, and then present value through discounted cash flow is done. Another is with and without the particular tangible assets, a projection is done, and the difference between the two value of the company would be the value of the intangible asset. Then there are other methods like real option pricing method. So here option pricing method, which is used for options and futures, may also be applied to the intangible assets. There may be another approach, which is the replacement cost method for the intangible assets. So let's say one patent is acquired or generated by investing a lot of money over a period of time. In research and development has been done. So what cost has been incurred by the company, that can be the value of the asset. If we talk about the startups, there are limited financial history of the startup. The growth is uncertain. There may be huge potential, but there are risks that potential may not be successful. That the expectation of the investor, founder, or the persons who have started the startup may not sustain. then maybe there may be lack of comparables. So because generally startups are disruptive, they have unique business models. So those uniqueness also make it difficult to have comparable data. So it becomes challenging to determine the value of the startup in that situation. As the business is just in the initial stage, nascent stage, there are high risk of failure. So that is also one very important factor while determining the valuation of startup. Then there may be investors who are putting the money, so their expectations would be there. Like investor generally ask for, let's say 20 times of 20 IRR at 20% or 25% IRR. So that investor expectations is need to be built in the projections and see whether that is sustainable or not. So those are the biggest challenge for the startup valuation. Again, if we are talking the loss-making entity, it may or may not be a startup. There may be certain companies which may start giving cash flow over a period of time. So the beginning of the business stage, there may be negative cash flow. Then sustainability can be an issue. There may be a turnaround situation, like company has just came out from the insolvency situations, and hence it may has the inbuilt capacity, but it's not yet started performing. There may be debts and liability which is much higher than the capacity to repay the debt. So all those situations make the valuation very challenging, and hence simple approaches, normal approaches may not be applied. If we are talking about the valuation of startup or loss-making entity, Barker's method is one of the simplest method. Then another one is the first Chicago method. So if we are talking about Barker's method, it gives various kind of subjective things certain weight, and then based on that the valuation is done. Like the idea, soundness of idea is given certain weight. Like say 20% is to the soundness of idea. Then whether the prototype is ready, whether it is can be shown to the market, that can be given certain factor. Then subjective capacity of the management, the founders, their interest into the business, their capacity to change to the environment, their capacity to continue or devote time to towards the idea, that will be given certain factors. Then strategic relationships can be given certain factor. Then product rollout and sales plan, sales timelines, all those things are given certain factors, and based on that the fair valuation is recalculated. Another one is the first Chicago method. Here again, scorecard is made for various risk factors, and based on that, the risks are summarized, and certain risk multiple is given, and valuation is estimated. Now comes to we have already discussed the approaches of valuation. Now we discuss about the regulatory provisions in India, based for which various valuation need to be done. So if we talk about valuation requirement, there are various laws under which companies need to do the valuation. First one is the Companies Act 2013, which is the primary act for any company in India. So under which for various kind of transactions, valuation need to be done, like for issuance of new shares, transfer of issuance of sweat equity shares, ESOPs, etc., etc. Then comes the income tax. Income tax also require valuation for various purposes, like transfer of share. So there is a need for fair valuation. Issuance of shares by unlisted companies, there is a need for valuation. So that need to be done. Then comes the SEBI law. If it is a listed company, there are certain provisions under which valuation need to be done by as per the SEBI Act and regulations made there under, like for preferential allotment or private placement of shares. For that, valuation is mandatory. Then for takeover of open offer, for which valuation, fair valuation is determined in case of infrequently traded, non-regularly traded companies. Then comes FEMA, Foreign Exchange Management Act, wherever there is a ODI or FDI transaction, money is coming into Indian company or going out from Indian company to any foreign entity, valuation need to be done. And for that, there are prescribed methods or prescribed persons who can do the valuation. Then comes insolvency and bankruptcy code. Here there are two situations. When the company goes into insolvency situation, there is a requirement of fair valuation by two registered valuers. And their valuations are placed before the board, before the committee of creditors to determine what should be the price or method to carry the bidding for the new investor. Then if the company goes into liquidation, there may be a requirement to do the valuation again. That is the fair valuation and the liquidation value of the company. And then comes the accounting standards. Indian accounting standard, again, there are requirements for the determination of fair value under the Ind AS. So under Companies Act, we are talking about the preferential allotment of issue. So if we are doing the right issue and shares are giving to everyone, every shareholders at par in the ratio of their already having investment, then there is no requirement of valuation. But if we do allotment to selective persons, then there is a requirement of valuation by registered valuer. Registered valuer is basically governed by Insolvency and Bankruptcy Board, but it is initiated through the Companies Act under Section 247. So that is one of the important aspects. And then allotment of shares for consideration other than cash, like some business is being acquired or assets is being acquired, and for that shares is not being issued. Then in that case, fair valuation need to be done by registered valuer. Then comes the sweat equity shares to be issued to any key managerial person, any person. Fair valuation is very important. Then comes submission to report by company under liquidation. For that, fair valuation is done. In case of merger amalgamation, there is a requirement of relative valuation of the two companies or two or more companies involved in the scheme, and their equity swap ratio is determined through fair valuation. So obviously, valuer will apply multiple methods or suitable methods considering the business aspects and then do the valuation. Any compromise arrangement to be done under the Companies Act. Here again, there may be a need for valuation. If we talk about the income tax, there are like determination of capital gain, issuance of unquoted equity shares, transfer pricing, issuance of transfer of unquoted shares, indirect transfer pricing, then transfer of shares and other securities, equity shares held by minority shareholders. All those need to be valued by different kind of valuer. Mostly the valuation is done by the SEBI registered merchant banker. Then comes SEBI. So under SEBI's regulations, SEBI prescribed regulation, preferential allotment is one of the most important aspects. For right issue, sometimes it is required. Then, but it is not mandatory in most of the cases. Only the base price is. It is for the board of directors consideration. Valuation is done. Then comes the delisting of shares. If the company is listed and the promoter want to make the company delisted, then a base price is determined and a fair valuation is carried for that. In case of open offer, takeover open offer of a listed company, and the company is not frequently traded, then the fair valuation is mandatory. In case of ESOP, again, ESOP need to be valued. Options need to be valued and as per the SEBI regulations. Under FEMA, if we are issuing convertible debentures, valuation is done. Then in case of cross-border transactions, valuation is mandatory. Valuation of assets in case of inbound investment, like FDI transactions, valuation need to be done under the FEMA law. Then if we are doing outbound investment in any wholly owned subsidiary or joint venture outside India, then fair valuation need to be done. In case of issuance of external commercial borrowing, valuation need to be done. Then if it is convertible. Then in case of repatriation of funds for a particular purpose, particular assets class, there may be a requirement of fair valuation. Under insolvency law, as I have already told, determination of fair value of the company going under insolvency or liquidation, fair valuation is done. Similarly, for personal guarantors value, there may be a requirement of valuation. Under Ind AS, there are various kind of valuation, like Ind AS 2 talks about the fair valuation of inventory to be recorded. Then first time, if a company is first time adopting accounting in Ind AS or migrating from AS to Ind AS, then first time adoption fair valuation may be required. And then Ind AS 113 talks about the fair value measurement. Similarly, AS 109, all financial instruments need to be marked to market through fair valuation. In case of merger amalgamation, Ind AS 103 talks about the fair valuation of both the companies and determination of swap ratio. India's 19 talks about the employee benefits. So accounting of options issued by the company to employee need to be done as per the India's 19. And then there may be other kind of assets like investment properties, biological assets, etc., which need to be fair valued and recorded in the books. So that is from my side, and we can have further discussion on the Q&A. I think next, Devashish will discuss certain part. Thank you.
Thank you, Manoj, giving a very detailed presentation on various aspects and various things in a very lucid manner and very short period. No doubt, all these things require detailed discussion when we will do program on a specific topic, like valuation of intangible, valuation for insolvency, valuation for M&A. Okay, but you have given the good overview on this. Now, future of valuation and what are the changes? I will request Mr. Devashish. He is a registered valuer, and he will discuss about these aspects. Over to you, Devashish. You have to unmute yourself. Unmute yourself. Yeah.
Yeah. Hi, good evening, sir.
Good evening.
Hi. Thank you for giving me opportunity for presenting these views. Now, regarding just share.
Yeah, presentation is visible. Carry on.
Yeah, just hold on, sir. Now, regarding future and challenges of valuation industry, first of all, let us see what are the challenges we are facing when we are doing the valuation. So the difference of our actual and the subjective observation may put a bias on the valuation assumption. It may happen. Now, regarding the intangible assets, now intangible assets were just Mr. Manoj Kumar has described. Now, I will delve into one thing, the valuation of brand, trademark, patent. Now, in this, for this particular three assets, we use relief from royalty method, where we assume a royalty percentage. This royalty percentage is put on the gross sales to get the royalty which this brand, trademark holder did not pay. So this is the income, and based on that, we go further to calculate the fair value of the brand. Now here comes the problem of identifying the royalty percentage. There was one particular valuer, Robert Goldstiger, who advocated a 25% of the gross profit before tax should be taken. But it was up to 2011. After 2011, US courts, they discouraged it. And now the valuer should take the royalty percentage from the portals like Markable Net or from royalty range. So it poses a challenge to us. Then there may be challenges where there is for valuation report, there was a subsequent event between the valuation date and the valuation report. Now, as per ICS standard, what they are saying that as per 36 of 201, standard 201, that the valuation report should be based on the status as on the valuation date. But between these two dates, valuation date and valuation report, there may be subsequent events which may be material. So the auditor has to, the valuer has to apply the judgment and to decide whether that has to be taken into consideration in the valuation report. Suppose there is some receivable. The receivable has it is not confirmed that whether it will be received. But before the preparation of the valuation report, the amount has been received. Now he has to take that thing into consideration. and to make the valuation report compatible with the the actual this thing picture. Now there is a market volatility. The market volatility there may be due to uncertainty, there may be market volatility. Now this may affect the volatility which is calculated, say for ESOP valuation Black-Scholes model. Now where there is a market volatility, say during COVID period, if we take that thing into consideration, and now that may affect our calculation of ESOP valuation. Lack of transparency. Many companies, they are not transparent. They don't share the information, so we have to make our own assumption. Many times we have to make our own projections. The actual may be different. So these are the issues which we are facing. Then legal and regulatory issues. The legal issues there may be cases, but the receivables or the collectibles, they are mired in some legal proceedings. Now there we have to take the legal opinion that at what stage that matter is pending and what is the probability of getting a favorable judgment. If the matter is pending at a lower court, then the party who will lose will definitely go to a higher court, and the legal cost and the this court fees, they will increase with each higher court. Say from arbitration tribunal to arbitration appellate tribunal, from there to high court, from there to Supreme Court. Now we have to take legal opinion that how much time may be taken and what are the legal costs involved. Based on that, we have to get a fair value of that particular asset. Now there may be emerging industries. There may be emerging industries which is making obsolete the earlier industries. Suppose recently in telecommunication, there is emergence of 5G technology. 5G, now which companies they have opted for 3G technologies, they become obsolete. And same for changing technologies. Now economic downturns. Now if a country has some economic downturn, like Sri Lanka, then there is they have an impact on the valuation. Similarly, the global factors. Because of the Ukrainian war, there is a lot of pressure on the crude price, supply chain of food delivery to underdeveloped nations. So all these things are putting, they are posing challenge for valuation. Now, as far as future of valuation is concerned, they have some factors that have a major impact on valuation. They are from three angles. One is from initiative by government bodies, another from ESG, another from technology. As far as initiative by government bodies are concerned, now recently, as last year, so by September 2022, Finance Ministry under Nirmala Sitharaman, they have a discussion, and they decided that now they will take the services of registered valuers for all government departments. This is number one. Number two is that there is a initiative, there is a proposal by IBPI that there are multiple valuation standards being followed. Say IBC advocates the International Valuation Standard. Companies Act 2013 advocates either International Valuation Standard or CA Institute's Valuation Standard. That also, this ambiguity was resolved after amendment of Rule 8.1 of Valuation Rule 2017, very recently. Now, still the confusion persists, and IBPI chairman, Mr. Mittal, has advocated a various, will be a uniform valuation standard which is acceptable globally and which will be observed by all the valuers. Now, let us see what decision they will take. Now, regarding other, just a minute. Yeah, there is some IP rules. They are intellectual property rules being framed by Ministry of Corporate Affairs, so that the startups and small scale industry, they can value their intellectual properties and they can capitalize the thing. I mean, they can securitize the intellectual property value and raise fund. So far, what they have commented that as time passes, the value of tangible assets decrease and intangible asset increases. But to capitalize the same, they are suggesting that there should be a valuation standard for IP. Now, coming to that ESG point, the ESG, as we know, it's a big issue now after this climate change and all these factors. And there is a recently, as late as in July 2023, SEBI mandated that the companies, the listed companies, they should give this ESG score. I mean, they will get the ESG score from ESG score giving authority. Now, when they will get the ESG score, the responsibility of the valuer is to incorporate that ESG score in the valuation. How? Now, one is that this comparables. There will be an impact of comparables as far as there is a recent report by Deloitte that if there is a 10% increase in the ESG score of the same company, there is a 1.8x increase in the marketable. So based on that, the valuer can modify their P multiple and arrive at the desired figure for the target company. As far as this is for market approach, as far as the income approach is concerned, they will take the ESG score. If there is an adverse ESG score, they will decrease the cash flow which is projected to bring it down to the level of that ESG observation. Say there is a additional tax to be paid for some imposed by the Pollution Control Board. Now, additional tax, if it is to be paid for pollution by Pollution Control Board as dictated by, then they have to reduce that amount to get that cash flow. Similarly, if they have to install some additional effluent treatment plant, then additional capex is to be incurred. Then that additional capex cost has to be deducted to get that cash flow, which is closer to the fact. Now, this kind of things, ESG score has bearing on the valuation. And similarly, while calculating the cash flow for income, adjusted cash flow for income purpose, the ESG score can also be used to get the modified long-term growth rate, because ESG, they delve on the sustainability of a business. Now, if the ESG score is adverse, then the long-term growth rate will be affected. That may be taken into consideration. Similarly, for a volatile industry, if the ESG growth is not favorable, then there has to be a bearing on the beta. We can also take that thing into consideration. So this is the impact of ESG score on the this comparables and the income approach. Now regarding just a minute. What is the objective of the ESG? The objective of ESG is the carbon neutral to be achieved by 2050 and zero emission to be achieved by 2070. Okay. Now, just a minute. Technology, there is a business part of technology for artificial intelligence related chat GPT, which has come recently. Now, AI chat GPT, they are able to do multiple tasks, which will be a boon to the valuers. So they can even write Excel formula. They can dig out data. They can even prepare the valuation reports now, and they can even cite the laws. I mean, for valuation companies, for valuation industry, they can write valuation report, but there is a one limitation that they will dig data from the public domain, what is available in internet. They cannot go beyond that. If there is a new research, I think there is a time limit of, I mean, say they can have access to data up to 2021. It was up to the last version of ChatGPT. I don't know whether it has been improved now. Now they can have that access, and based on the access up to that point, they can give result. So for valuation industry, if we get the report done by ChatGPT, then we have to cross-check with the latest development, regulatory and or otherwise, that whether it is in sync with the present, I mean, the latest picture. This kind of thing we can have. Now, artificial intelligence has some other application also, data analytics, Python, Power BI. When there is a, today, data is the main source for analysis. Now we can deploy this Power BI and other Python, what I have said, for data analysis and to get into the gist of the picture that, I mean, we can focus on that thing. Okay, these are all from my part.
Okay, thank you, Mr. Devashish. You have rightly pointed out the valuation require not only the technological advancement, but also presentation. So when you are talking BI, then it is very clear that when you give the data number should speak itself. For that, you require better presentation. So BI is one of the best tool to give. And you should also have a logical conclusion of the numbers. You can't just write the numbers and say this is the valuation. Today, everybody want to understand that what parameter you have taken, what parameter you have not taken, and how you have arrived to this valuation concept, and what are the other things we have missed out. All these things has to be part of this. So thank you very much. Now we have discussed today the entire aspects of various process, valuation framework, valuation future, valuation, what are the things covered. I discussed about the various instruments, various type of valuation, future of the valuation. So everybody can understand this, that this concept is not just a concept which was a part of the one chapter of some particular law of accounts. Now it's a full-fledged, detailed department, detailed work, detailed institution, and then multiple new project, new things, the methodology, the new instrument, new process, multiple process, everything is there. So we are seeing in future that valuation institution or valuation aspects, valuation professional will have their own position, like chartered accountant, company secretary, advocate, and cost accountant. Same thing, the valuer will also be there. No doubt, valuer there, actuary valuers were there, other valuers were there, but their recognition was not like this. The recognition was also not there, and the ecosystem was also not there. So this ecosystem is developing. And today what is happening, if you are talking to anybody for any things, whether you want to go to IPO, whether you want to go for startup valuation, whether you want to go to anything, first question is, what is the valuation of your company? And then there is a discussion, and then rest other things follow accordingly. So thank you all my three speakers. Now we have various questions we have received. Okay, so this I just want to discuss, and I will start with Sanchit. What is the validity of valuation report, and where provision for the validity are mentioned?
See, with regards to the validity, no such provision actually mentioned that this is the validity. If there is no material change that is given, we can use the valuation report, but although valuation report is always for a point of time or at a date. Usually what industry practice is that valuation report can be used for 6 months from the day it was done. However, if there is any material change or transaction that has occurred between that, it will not be valid.
Okay.
Just
What? Yeah. Yeah. Your Devashish, your voice is cracking. Just
for FIPA UTI,
yeah.
the validity is 3 months. There is one exception.
Okay. So point is the 6 months is normal validity and FDI validity is 3 months. Okay. For valuation. Okay. What are the common method used for valuation, Manoj?
Then, as I have already discussed, there are three major methods. One is asset-based valuation method. Another is income-based valuation method, which is discounted cash flow mainly. And the third one is basically comparable company transaction methods.
Okay,
These
Manoj,
are
all
these are
three.
the approaches, and through under these approaches, valuation is done. Like in case of asset-based approach, we can have existing book value-based method or replacement cost method. Similarly, income-based, we can have PECV, price earning capacity multiple method, which use the historical track record of established business, whereas DCF goes for the future projections of the cash flow. So these are the nuances under approaches, but there are the three broader basket under which all kind of valuation asset cash, basically financial asset valuation is done.
Okay, Sanchit, when this Manoj has mentioned three types of valuation. So when we are using this type of valuation, discounted cash flow, when we are using in which type of things, just explain.
So basically, discounted cash flow is one of the methodology for income approach. It is usually dependent upon the projected revenue or cash flow that a company would be generating in the future year. The premise of may differ from different cases where we have to figure out on what is the purpose of the valuation that we require and what industry we are targeting to. It is only then that we can finalize if discounted cash flow can be utilized or not.
And what about the asset valuation?
So again, asset valuation is a methodology where we focus completely on the quantitative aspects of the assets and the liabilities, which is what the financial statements of any company depicts. So that is what would be the asset valuation. It would depend upon the premise and the base that we use.
Comparable?
Again, comparable is called as actually the relative valuation methodology, where we use a similar company which is in the similar industry, appropriate the premium and discount, and calculate the value with respect to that.
Okay, Devashish, you want to add anything in this?
No,
Okay.
sir. No.
Okay. Manoj, what role do financial statement play in business valuation?
Financial statement is the first step to determine any company's valuation. So we have to analyze the finances of the company, stage of the business, cash flows of the history. Let's say we are talking about the future, we are doing discounted cash flow. But so there are projections for future 5 years, but we have to see the trend in the past. So for that, financial statement is the key. Then we have to, even if we do the projections, we have to determine to give addition or discounts for, let's say, cash in hand, any assets which are surplus asset which are not generating the cash flow. For that, we need to go deep dive into the financials of the existing finances of the company. So existing finances are the base on which all the valuations are done. Sir, you are mute.
Sorry. Sanchit, what factors should investor consider when valuing a company stock?
So again, when we talked about the factor, both qualitative and quantitative factors should be taken into consideration while the investor should take into consideration for valuing a company. So qualitative factors would be the management, the quality of the products and the services, as we discussed, the regulatory, geopolitical factors, the industry regulatory aspects are the qualitative things. With respect to the quantitative things, we should focus on the profitability metrics, the growth potential, the revenue potential, the assets, liabilities, debt, equity, debt structure. These are things that we should be taking into consideration for any investors.
Okay. Manoj, what is the role of risk-adjusted return in private equity valuation?
So basically, all private equity investments are subject to, for the purpose of earning certain return. They are not doing the business. They are not carrying the business themselves. They are banking upon someone else to carry the business and earn for them. Because private equity are structured, there are certain persons who are managing the fund pooled from the various persons, which are called the limited partners. So limited partners have certain expectations from the investment, and their investments are pooled. And then there are management costs. So all those costs are factored in, and based on that, their earning requirements are there for each private equity or venture capital funds. Now, because they are making investment in any business which is not run by them, they have no control on the day-to-day affairs of the company. So they have, and there may be, because each investment has certain risks. So it may be internal risk as well as external risk. So considering all those risks, they put certain requirement of return, and based on that, they carry the valuation. So let's say they expect a return of 20%, and there are risks. So for risk, they are giving a premium of 25% more. So they will be asking a 25% return, and based on that, they will be investing in the present of the company. So over a period of, let's say, 3 years, they want to exit, and they want a 25% return or 20% net return. So they will be asking for 25% return, so that at least even after all the risks, they will get at least 20% IRR. So that is the risk based return expectation.
Okay. Devashish, can you explain the concept of a leverage buyout and its impact on valuation?
Leverage buyout means that we have taken loan to buy a company. Now, when we are taking loan to buy a company, then we have to see the valuation of that company which we are going to buy, and whether it is making sufficient profit to pay the interest component, I mean, to service that loan.
Okay. Manoj, you want to add anything, Sanchit, Manoj?
Yeah, so yes, so sir, basically leverage buyout is the buying a business or assets, considering the cash flow of that business or asset. So, and the security would also be that asset only. So bank is financing basically the company which is being bought by some another person. So let's say there will be management change, but the business will remain the same. So it is generally done in case of insolvency situation or liquidation situations where the asset has value, but the cash flow is not getting generated right now. The new management is coming, and they are saying bank would get the security of that asset only, that business only, and from their cash flow only they will repay the bank. So bank has to look into the financials, possible financials of the company, possible cash flows from the company, and whatever the period, let's say the liability repayment period is 7 years. So they have to see whether each year they can earn such amount so that the interest as well as the principal repayment obligation is paid. So that factor would be determined. The investor, the buyer, will only put the management, their own management, not put any asset or any cash flow further into the company.
Okay. Sanchit, because when we do valuation of the asset, you can see, you can touch and feel, and you can identify, because some rack rate is there, some usability is there. But what are the valuation for tangible asset? What method commonly you are using when you are doing valuation of intangible asset?
See, when we take intangible asset into consideration, we have to look into the aspect of various methodologies for them, because they don't actually have any tangibility value attached to them. So the intangible nature of the asset has usually revenue dependability over them. So what is the value or what is the revenue quotient that they're going to be generating in the future is how their value is determined. There are few methods that we use, which are royalty relief method, with or without method, multiple cash earning method. So if I may tell you about one of the method is called the with or without method, where let's say if any intangible asset is there into any company, whether it's a brand, patent, trademark, we will associate what would be the revenue cash flow of that company or that asset with that intangible asset in its place. And we will take out the discounted cash flow and calculate the value. And we will calculate the value without that respective patent or trademark or any brand associated with it and calculate the trademark. The difference between both of them would be the value associated with that respective intangible asset.
Okay.
So this is one method.
I have to add on the point, sir.
Yeah.
Hello?
Yeah, please.
Yeah. As far as the valuation of trademark is concerned, once trademark is registered, it is valid for 10 years. Okay, now when a valuation assignment is coming for trademark, we may assume that whether we have to see whether the registration is valid now at that point of time, then we shall assume that the valuer, the buyer who will take this thing, he will renew after the this particular 10-year period lapses, ends. Now, assuming this, we will calculate, we will take into consideration the projected revenue. Then I am talking of relief from royalty method of calculating trademark. Sanchit has given idea about with or without method. This is relief from royalty method. Then after assuming this continuation of trademark in perpetuity, we have to take into consideration the projected revenue. Then from projected revenue is multiplied by the relief from royalty percentage, which I have told during my presentation that what we will take from markables.net or royaltyrange.com, this thing. And then we will multiply that thing to get the net royalty. After also, we will deduct some brand maintenance cost, say 3 to 5%. After we get the net royalty, we will deduct income tax from it, and then we will calculate the terminal value based on the growth rate. We will assume for that particular for the company in which industry it belongs. Now, after that, we will take the discount rate. Preferably, we will calculate taking into consideration the risk factor of that entity, because we are calculating intangible, so risk factor will be a little bit higher. Now, after getting the discount rate, we will calculate discounted cash flow. Also, the terminal value will be discounted. And after getting that present value, we will apply tax amortization benefit. We will assume an amortization period of, say, 4 years. Then we will get the fair value of trademark.
Okay.
Sir, I think this is, there is one question relating to the same, which Sanchit has just told, relating to with and without method. So he is asking how to determine the change in revenue due to the brand or reputation attached, right? So obviously it is subjective. We have to do the projections. So generally the management do the projection based on the projection of cash flow over a period of next 5 years, and then maybe longer period also, considering the factor for which the asset for which we are doing the valuation. Let's say we are talking about some patent, and patent has given some premium to the specific medicine. Let's say we are talking patent for some medicine, and the patent life is 15 years. So there will be a projection for 15 years. Without patent, if it is a generic medicine, what should be the price? And if with patent, if it is a patented prescribed medicine, so what will be the difference in the pricing based on the projection will be done. And obviously the valuer will do the sanity check whether it is logical projection or not, and based on that the valuation will be done.
And what about the cost aspect? Suppose you are spending, suppose you have to launch a brand and then you have to spend money on advertisement and various other
Right.
aspects.
So that is one of the methods. Sometimes we do not apply this with and without method or royalty relief method. We generally simply go for the cost of intangible creation also. Sometimes it is also a valid method for determining. All those depend upon the scenarios, specific entity, company, and based on that, right method is applied or deployed by the valuer.
Okay. Okay. Sanchit, now you have just mentioned startup. Okay. So what method are suitable for valuing a startup company with limited financial history? Because other company has a history, they don't have a history, they have an idea. And they have no profitability also, no test. They have a starting point. Okay. But the concept is there. So how?
When it comes to companies with no financial history, like in cases of startup in today's era, the only reliance that we can actually give on is the future cash flow, future projections. Again, it depends upon the startup is at which stage, whether is it at ideation stage, whether it is at pre-revenue stage, or whether it is at Series A, Series B, Series C, or what development stage it is at. Once that has been arrived at, it is at subjective nature of that related startup industry that the valuer relies upon. We have to take into consideration the cash flow projection that the founder of that respective startup has given. We have to do a sanity check on whether those projections are justifiable or not, whether the industry can actually place reliance on the revenues that are being projected in the future. So a lot more factor has to be given into the financial model that has been created and the reliance upon that and the justification for that respective projection. Once we have done that, we have to choose the relative valuation methodology, as was said by Mr. Manoj Kumar, whether we have to use first Chicago methodology, Berkus methodology, or any of the methodology to take into consideration for that value.
Okay.
So like if we
Yeah.
choose the first Chicago methodology, we can take into consideration the scenario analysis of this DCF, where best case, worst case, and an average case scenario can be taken into consideration, which is a more conservative approach when there is limited financial history. And similarly,
Yeah.
other methodologies into
Okay,
consideration.
now time is short, so I'm starting rapid round. So you have to give just a very short answer. Okay. Manoj, how does the risk profile of startup impact its valuation?
So yes, as Sanchit was just talking, we have to, there are scorecard methods where we give various factors to various kind of subjective aspects of the valuer, company, entity, startup, like potential of growth, market size, management decision, management's skin in the game, all those factors, and based on that, scorecard is given. Alternatively, like we can say best case scenario, worst case scenario, or based on high discount is been given, and that is considered to be a fair valuation.
Okay. Yeah. Now, can you explain the concept of pre-money valuation and post-money valuation in startup funding rounds, Sanchit?
So pre-money valuation is what the valuation that we do before any funding has come into the company. Post-money valuation is basically whatever the valuation that we calculated plus the funding amount would be the post-money valuation. So let's say, for example, if a pre-money valuation that we arrived using all the three approaches comes out at $10 million and the company is raising $2 million, then the post-money valuation would be at 12 million.
Okay, Mr. Devashish, how does the stage of development, seed, Series A, B, impact the valuation of a startup? Very short answer.
The venture capitalist who invested, if he wants to quit, then there will be a cash outflow from the company. Then the valuation will come down. But then in that case, the founder will get 100% stake or the majority stake of that entity. So based on that, we have to balance that what will be the impact on the startup entity.
Okay. So, Sanjit, what are the primary method of valuing a pre-revenue startup and no sales of or profit?
Again, as I told you, in case of the startup which has no limited financial history, we'll apply the similar principles.
Okay. So, Manoj, can you explain the concept of burn rate and how it affects startup valuation?
Concept of, sir?
Burn rate, or the concept burn rate and how it does affect startup valuation.
So burn rate is the basically the concept. The founders may like to exit from the company, or possibility of it not going anywhere. So that is a subjective things, and which can be applied as a subjective parameters while doing the valuation.
Okay. One of the 2-3 quick question on merger and amalgamation, because you have handled this. How do financial analysis determine the value of company in the context of M&A deal?
Obviously, in case of merger amalgamation, there is generally a comparable valuation, so a relative valuation. So two companies are there. We have to determine the valuation on putting those two entities at same parameters, and then check with what is the best suitable method to determine the valuation. So we need to determine the equity swap ratio. We generally apply all the three approaches and test each of the approach on both the companies. If one company, let's say, is listed one and another is non-listed, so market approach may not be, market price may not be available for both the companies. For one company, we can see the running market capitalization as one of the value for the equity. But for unlisted company, we have to apply the comparable company based method, that is CCM based valuation. Similarly, we also apply the cash income approach, cash flow, if both the companies are able to give projections of the cash flow, and then the DCF can be applied for that. Different weightage is given to different approaches of valuation, and based on that, a swap ratio is determined, which is a relative valuation between the two entities.
Okay. Sanchit, can you just tell me that companies are doing valuation when they are either required by a regulator, or they are doing valuation when there is some transaction is going on. And sometime when they are going for transaction, and this question I will pose to all, okay? So I'm just addressing first. And when they are going for transaction, then the other party, those who are investing, they are coming out with so many problems with this, that you don't have this, you don't have this, your this analysis is poor, this ratio is poor, okay, which is no doubt it is there, but it was measurable and correctable. But you have not done so. When you are going for the valuation on the event-based valuation, what is the best way to do this? So company can prepare it, keep it ready, and prepare for future. What are the process you suggest to the corporate world?
I think what you're really talking about is what to be done in case of transactional related valuation, precisely voluntary valuation,
Yes.
taking into consideration where there is internal strategic decision to be making. So for any company, it is very important and imperative that they make sure that they are progressing in the right manner. Probably in today's world, what promoters and founders do is that they see that their revenue is growing, so that means they are progressing. Their profitability is growing, that means they're progressing. Definitely, that is one way to look at it. But what would be the right approach is to know exactly if they're progressing in a cumulated manner or not. Probably the company's revenue might be growing and profitability would be growing, but so is the debt. So is the debtors, or so is the creditors. And are there any repayments? So there are a lot of factors that are not taken into consideration when we look at only from one side of the ball. That okay, the revenues are growing, so my company's value is increasing. My profitability is growing, so my company's value is increasing. What we have to look into the consideration of the qualitative aspects as well, along with other quantitative factors. So it is very important that a valuation is important at least once a year, or at least before any material changes that comes into the company. So it would help in their strategic decision making. It would help in taking a more informed decision on when to expand, how to expand. It could help in their financial reporting. It could even help in garnering their credibility in front of the world as well as in front of their employees, because employees don't have a take, or the world doesn't have a take on what their revenue or profitability is.
Okay. Okay. Manoj, you have any point?
Yes, sir. So generally, the persons who are doing the business may not be understanding the nuances of the valuation. So if we go for a voluntary valuation of a company before any actual transaction is happening, and try to find out the gaps, what an investor can look into while doing the valuation, while doing the investment decisions, and those factors may be enhanced or corrected, whatever the parameters are there, which may be a decision making factor. Those factors may be corrected by the management. Then they can get the right value or fair valuation, better valuation from the investors. So it is always good to go for a voluntary valuation, and then based on that, a gap analysis may be done, and then corrective measures may be done. Certain things are non-queryable, but certain things are in hands of the management. So those factors may be corrected over the period, and then real valuation or better valuation can be fetched from the market. So that is good idea.
So you mean to say that this is the best way that you should go for voluntary valuation and keep it ready and correct it. When the times comes, you are ready. Okay.
Yes.
Now it's a time to close this session. So as we are usually asking that what the entire valuation gamut, and what is your suggestion in 30 seconds? Over to you, Mr. Devashish.
We have to take the help of ChatGPT to see whether valuation reports can be automated. To that extent, it is possible, but not blindly depending on that.
Okay. Sanchit?
So valuation as a field is quite big, and it is something that is important at every step what company takes, any material change that company takes. And all these fundamentals, approaches, methodologies was a step to make people understand on what are the things that are required when valuing, what are the things that a valuer takes into consideration when valuing. This is what was the intention, and as a field, it is now growing. We also ourselves has to take into consideration the technological advancement that are coming into the valuation, with different kinds of asset classes that are entering in this field, complicated securities, instruments that are entering, probably things like crypto, blockchain, non-fungible tokens, all of these paintings, art. So a lot of things have to be taken into consideration while valuation.
Okay. Last, Manoj, you.
Yeah. So, sir, in India, valuation was never a separate practice or a known practice area for any professional. It was an ancillary business for ancillary practice area or ancillary profession for any of the charter accountant, cost accountant, or some merchant banker, investment bankers. So now it is growing as a full-fledged business, full-fledged practice area. So a lot of things are changing. Similarly, importance is being given to the valuation because private equity transactions are increasing, IPO capital market is growing. So valuation is going to be very important aspect for any business, and everyone need to focus on the factors which helps to unlock the value of any business. So that should be the key, and all professionals should look into the factors which can help to to raise fund, help to grow business by focusing on the valuation aspects.
We are waiting for the draft valuation bill to be passed.
Yes, it will be soon a new profession, and so it is growing very fast. Importance are being given to the valuers.
Okay, Manoj, there is one question has come urgently. I'm just asking you, Sanchit has given a thought on the intangible valuation with or without process. in this case, do the consider change in revenue when tangible like brands? How do you determine change in revenue?
Sir, we have already answered this on real-time basis. I think additionally, he has asked for, while doing the valuation of intangible for an acquired company at a later stage,
Yes.
do valuer look into the PPA report on IFRS?
IFRS.
Yeah, or customer suppliers relationship and trademark. Yes, all those factors are taken into account while doing the valuation. So we have to, yes, go deep into the things. Due diligence is very important. Valuer has to carry diligence, and based on that, he applies various methods and discounts and premiums.
Okay. I think so one comments for all of you. A really good thought, provoking an excellent session. Thanks to entire corporation team. Thank you, Mr. Ramesh. Thank you very much. So friends, today we have given the entire gambit of valuation, and the most important thing which has come out, that this is not an ancillary work now. This is a full-fledged work and the complete work in itself. When there is a complete thing, then you have to work out various dimensions also, various ills also, how to curtail this and how to promote this. So now you have to promote, remove the problems, then remove the ills also, and make this institution bigger. And you have to take care of each types of valuation, because you don't know what are the problems will come, what are the new instrument will come, what are the new types of valuation will come, that you have to take care. So with these things, I'm closing this session on this part, and thank you all my three learned speakers, Mr. Devashish, Mr. Sanchit, and Mr. Manoj. Thank you very much. Friends, this journey of sharing knowledge is continuing, and we are proudly coming out with every Friday with the one additional number. The today it was 145th webinar. Now I'm announcing for 146th webinar. We will do webinar on Digital Personal Data Protection Act 2023. And this, our main speaker will be Pawan Duggal, who is a cyber law expert. And he will discuss about the Digital Personal Data Protection Act. It's everybody should know, each corporate should know, who is interacting with the client, who is interacting with the customer. And simultaneously, you also should know what is your right, how the people should not use your personal data, and if they are using, what are the prevention you can do. With these things, thank you very much. See you on next Friday, 22nd September, 4 o'clock on Digital Personal Data Protection Act 2023. Thank you very much.
Thank you, sir.